All right, let's get right into it. We're going to tackle a massive question today, one that's right at the heart of our entire economy. How is money actually created?
Okay, so you've heard the phrase a million times, right? The government is just printing money. You probably picture these giant machines churning out sheets of dollar bills. But what if I told you that whole image is basically a myth?
Yeah, so the big takeaway right from the start is this. Forget the printing presses. I mean, sure, physical cash gets made, but that's not what the experts are talking about. The real action, the creation of most money, it's totally silent. It's invisible. It happens with a few keystrokes on a keyboard. We're talking about a digital bookkeeping operation, pure and simple.
So to really get our heads around this digital world, we need to meet the key players. Think of it like a play with three main actors. Each one has a very specific and very different job to do.
First up, you've got the US Treasury. Now, these are the folks who physically print the paper money and stamp the coins. But here's the twist, and it's a big one. They're just manufacturers. Think of them as replacing worn-out bills, like swapping an old t-shirt for a new one. They aren't actually increasing the total amount of money out there.
Okay, next on our list is the central bank. In the US, we call it the Fed. Now this is the creator. When you hear economists talk about money printing, this is who they mean. The Fed creates digital money, these things called bank reserves, literally out of nothing. That's what ex nihilo means. Poof. It just appears as a new entry on their digital ledger.
And now for the one that blows most people's minds. Commercial banks. Yeah, like the bank you have your checking account with. They're the multipliers. And get this, the vast majority of the money in the economy, it's created by them, not the government. When a bank gives out a loan, it simultaneously creates a new deposit. And just like that, new money is born.
Okay, so if the Fed is the creator, how does it actually get these huge sums of digital money into the economy, especially when things go wrong? Well, that's when they bring out the heavy artillery. It's a tool that's often called the Big Bazooka, and its official name is quantitative easing, or just QE.
The way it works is actually pretty straightforward when you break it down. Step 1, the Fed creates that digital money we talked about, just by typing it into existence. Step 2, it uses this new money to buy things, usually government bonds, from the commercial banks. This swamps the banking system with fresh cash, what economists call liquidity, and the whole point? To drive down interest rates. That makes it cheaper for you to get a mortgage, or for a company to borrow money to grow and hire people.
And you really need to see the numbers to grasp the sheer scale of this. I mean, look at this. Before the 2008 crisis, the Fed's balance sheet was hanging out at less than $1 trillion. Fast forward to 2014, after all that QE, it exploded to $4.5 trillion. And then the pandemic hit. By 2022, it peaked at almost $9 trillion. We are not talking about a small change here. This was a tsunami of digital cash.
So, the big question is, what happens next? What are the real-world effects when you pump trillions of new dollars into the economy like that? Well, it's a bit of a double-edged sword. The goal is stimulus, but you also get some pretty serious side effects, like inflation and growing inequality.
Look, the intention behind QE is understandable, even noble. You're trying to stop a full-blown financial meltdown and kickstart a struggling economy. But there's a catch. All that new money has to find a home. And where does it go? A lot of it flows right into financial assets, stocks, real estate, sending their prices soaring. And that leads to higher prices for everyday stuff, and importantly, it makes the gap between the haves and have-nots even wider.
And this quote just nails it, doesn't it? If you're someone who already owns stocks or a house, QE can be great for your net worth. But if you don't own those assets, you don't see any of that benefit. You just see the downside. Your rent goes up, your groceries cost more. It's a policy that hits people in completely different ways based on their wealth.
Now, we have to be clear here. The crazy inflation we saw recently wasn't only because of money creation. It was more like a perfect storm. As you can see, the stimulus was a huge piece of the puzzle, for sure. But you also had supply chains around the world just completely breaking down. And then you had this massive spike in energy prices. So yeah, it's a complicated story with a lot of moving parts.
Okay, so this brings up a really obvious question, right? If the Fed can just create money with a keyboard, what's to stop them from just printing endlessly? Why not pay for everything this way? Well, it turns out there are some pretty powerful brakes built into the system.
Think of it like 4 major guardrails keeping the whole thing on the road. The first and most obvious one is inflation. If prices start spiraling out of control, people get angry, and it becomes a massive economic problem. Then there's the fact that the central bank is independent. This is key. It's designed to protect it from politicians who might be tempted to just print money to win an election. And finally, you have the rest of the world watching.
If bond investors think you're being reckless, they'll demand higher interest rates. And if international confidence in your currency disappears, it could trigger a collapse.
But what happens if those guardrails fail? What if a government throws caution to the wind and just hits the accelerator? Well, that's when you get into a truly terrifying economic death spiral called hyperinflation. The textbook case for this is Weimar Germany back in the 1920s. Crushed by war reparations, the government just started printing money like there was no tomorrow. The result? Total currency collapse. I mean, by the end of 1923, prices were doubling every few days. Imagine your entire life savings becoming worthless in just a few months.
And this quote really brings home just how absurd it got. People were getting paid twice a day. Why? Because the money you got in the morning would be worth way less by the afternoon. This isn't just an economic problem anymore. It's a complete meltdown of society, where money itself loses all meaning.
And this is a really important point to understand. Hyperinflation is rarely just a monetary phenomenon. It's a symptom of a much deeper problem. It's a sign of a failed state, a government that has lost control, can't collect taxes, and has no other options left but to turn on the digital printing press.
Which brings us all the way back to today. Knowing how money is really created, not with ink, but with keystrokes, and on a scale we've never seen before, is absolutely critical. So I'll leave you with this to think about. As government debt around the world hits record highs, is the temptation to just keep hitting print becoming irresistible?